a global financial crisis with massive impacts that lasted for decades. It was once considered a dark spot in the US economy, and it still haunts investors to this day. It all started when the real estate market kept heating up, with prices rising nonstop. This led millions of people to rush to borrow money to buy homes and speculate on real estate. Banks, in turn, made loans recklessly and without strict standards. Then, when housing prices dropped, the real estate bubble burst. Many people could no longer repay their loans. This hit banks and financial institutions hard, with some even going bankrupt. The result? A global economic recession. This was a costly and invaluable lesson about managing financial risks, both on a personal and global scale. So, in today's video, we'll discuss the 2008 global financial crisis. From it, we'll draw lessons about greed, smart investing, and staying rational in the market. I am Drake Lee, and this video is based on research from many sources, combined with my personal opinions and perspectives. If there are any errors or points needing clarification, feel free to comment below. The story begins in the 1990s, a time that marked the explosion of the information technology era. It was also the era when Windows 95 was born. This incredible yet promising technological advancement led to a wave of speculation and encouragement for tech investments on Wall Street. It could have been a great success if not for some terrible events. It started with the 9/11's Twin Towers attack, followed by a series of collapses from 1999 to 2001. What were these events and how did they affect the US economy? I'll save that for another video. For now, let's focus on the main issue. So with all the bad signals, investors and banks became more cautious. And of course, when the market is unstable, people turn to government bonds, the safest politically backed investment. At the time, the Federal Reserve, FVD, set bond rates at about 6.5%. However, holding large reserves in the Treasury doesn't mean a country is wealthy. Money needs to flow into the market, reaching investors, especially dynamic private enterprises, to ensure real economic growth and strength. So, from 2001 to 2003, the Fed continuously cut interest rates, reaching a low of 1% by mid-2003. The goal was to stimulate business and consumer activity. We've discussed this before. Lower interest rates mean more borrowing. More borrowing means more investment and spending, which fuels economic growth. But these rate cuts also made buying bonds less attractive. Why invest in safe bonds when higher returns are available elsewhere? This opened the door for Americans to access money more easily, improving their quality of life. It stimulated the US economy, which became particularly vibrant from 2004 to 2008. Investors shifted focus from risky tech companies to more stable assets. Real estate, which seemed like it could never lose value. Owning a home was a top priority for Americans at the time. With super low interest rates, people confidently went to banks to borrow money to buy homes through mortgages. A mortgage loan means the borrower provides collateral to guarantee their loan. If they can't repay, the bank has the right to seize the collateral. In this case, people used the very houses they were buying as collateral for their loans. They got a house, didn't have to pay up front, and secured their future. It seemed like a win-win situation. Now, how did this type of mortgage work? Let me give you an example. You want to buy a house but don't have enough money. So you borrow from the bank. The bank agrees to lend if you have a stable job and, most importantly, collateral. If you have no collateral, you can use the house you're buying. The bank lends you the principal amount and charges monthly interest. Your job is to repay both the principal and interest over time. If you can't, the bank takes the house. This is a normal activity in the credit market. Back to the US, at that time, super low interest rates led to a surge in people borrowing money to buy homes. For 10 years, America enjoyed a happy period. The poor could afford homes, and the rich bought bigger ones. Real estate agents easily earned commissions. Banks secured collateral agreements, turning them into financial products to attract investors. Investors leveraged finance to speculate, believing these mortgage-backed securities were as safe as government bonds. Banks then had an idea: bundle these mortgages into investment packages called MBS, mortgage-backed securities, and sell them. An MBS, or mortgage-backed security, is a financial product backed by home loans. Let me explain it in detail. Imagine Bank A gives 50 people home loans worth a total of $1 M. Each loan has different interest rates and repayment terms. These 50 borrowers must pay monthly interest to the bank. But once Bank A has lent out all this money, it runs out of funds. What if the market demands another $1 M in loans? To raise more funds, Bank A creates an MBS. They bundle the 50 home loans together and divide them into smaller units, each worth 100 million VND. These units are then sold to investors. By selling these units, the bank receives fresh cash and can continue lending to more people. Meanwhile, investors who buy MBS units get regular payments from the bank, which come from the monthly repayments made by the 50 borrowers. In simple terms, it's a way of recycling money. The price of these MBS units was reasonable with great potential, as they provided monthly interest payments and were backed by banks, making them seem risk-free. As soon as they hit the market, MBS became incredibly popular and quickly turned into a hot investment channel. High demand drove their prices up. Seeing this, banks rushed to create more MBS to sell. However, to make more MBS, banks needed more borrowers. For someone to borrow, they had to meet traditional lending conditions: a stable income, good credit history, and most importantly, the ability to repay. But not everyone could meet these conditions. Banks, eager for more borrowers to create new MBS, decided to loosen their standards. They introduced subprime loans, loans given to borrowers with poor credit or who didn't meet traditional requirements. In simple terms, these were people with low credit scores, unstable incomes, or bad credit histories, like unpaid debts or bankruptcies. Importantly, many of these borrowers were unlikely to repay their loans. Banks were willing to take on these risks to issue more loans. This led to an explosive credit market. Even people who couldn't afford repayments could easily access loans. As more people borrowed to buy homes, banks created countless MBS packages, generating massive cash flows. Investors flocked to these MBS, believing they were as safe as government bonds. Banks didn't stop there. They introduced other investment products, such as CDOs, collateralized debt obligations. CDOs bundled various loans, including risky ones, and were divided into risk levels from AAA, safest, to CCC, high risk. It was like cooking leftover fish soup. Instead of throwing away unsold fish, the chef turns it into a seafood stew, adds some seasoning, and serves it as a new dish. Some customers might enjoy it without knowing, but whether they get food poisoning depends on luck. CDOs worked the same way. Unsold MBS were bundled, categorized by risk, and sold to investors. Low-risk CDOs offered low returns, while high-risk ones promised higher returns but carried significant default risks. CDOs were promoted as a way to enhance the financial system's connectivity. Rating agencies assigned credit ratings to CDOs, guiding investors in their decisions. However, many CDOs containing subprime loans were rated AAA, making them seem as reliable as U.S. government bonds. This misrepresentation misled investors into pouring money into these products. The U.S. real estate market at this point was like a wooden tower. Each plank represented a mortgage package. The top planks, AAA-rated bonds, were seen as secure and guaranteed by the U.S. government. But the foundation was made of subprime loans, risky and unstable. As the foundation crumbled, the entire tower collapsed. The rise of subprime loans without proper risk management laid the groundwork for the 2008 financial crisis. Banks and financial institutions played a central role in this. Cutting interest rates to 1% had fueled a real estate boom. Real estate developers built recklessly, and people borrowed without considering their ability to repay. By the third quarter of 2008, over half of the U.S. housing market's value was financed by loans, with one-third being bad debt. The inevitable happened. Subprime mortgage debt in the U.S. grew at a staggering rate. Recognizing the growing risk, the Fed raised interest rates from 1% in 2004 to 5.25% by mid-2006. The goal was to reduce housing demand and control inflation, but this decision triggered a butterfly effect that changed the global economy. Higher interest rates shocked borrowers. Suddenly, mortgage payments far exceeded the value of their homes. Some defaulted and sold their homes. Others abandoned their loans entirely, forcing banks to seize and sell properties at low prices to recover funds. Foreclosures skyrocketed, from tens to hundreds to thousands to millions. As supply increased and demand plummeted, housing prices collapsed. The surge in foreclosures caused the U.S. housing market to crash. By 2008, outstanding mortgage debt had grown from $160 billion in 2001 to $1.3 trillion. As mentioned earlier, over half of the housing market's value was financed by loans, with one-third classified as bad debt. The real estate market froze, prices plummeted daily, and there was no way to stop the decline. Banks stopped receiving monthly payments from borrowers, so they couldn't pay MBS or CDO investors. Investors, in turn, panicked and began selling off these financial products, causing their prices to collapse. The peak of the crisis came with the collapse of Lehman Brothers, a major securities firm and the fourth largest investment bank in the US. This event triggered a dark period for the global economy. Lehman Brothers' downfall shocked the financial world, causing banks worldwide to lose trust in one another. As the saying goes, a market runs on trust. Without trust, there's nothing. The rise in bad debt put immense pressure on banks, as the value of their collateral, especially mortgages, dropped dramatically. At the same time, most borrowers couldn't repay their loans. Adding to the problem was the US's prolonged low-interest rate policy, which devalued the US dollar and other major currencies. For instance, South Korea's won lost over 40% of its value, reaching its lowest point since the 1997 crisis. Investors shifted their money into safer assets like gold. The crisis claimed several victims. Washington Mutual, one of the largest consumer banks in the US, declared bankruptcy. Merrill Lynch, a leading brokerage and investment firm, was forced to sell itself to Bank of America to avoid collapse. These are just two examples of the heavy losses and instability the financial world faced during this period. Major companies struggled, leading to a significant decline in global stock markets. The S&P 500 in the US, the FTSE 100 in the UK, the Nikkei 225 in Japan, and other Asian and European markets all saw deep losses. The S&P 500, which tracks the 500 largest US companies by market capitalization, dropped sharply during the crisis. From a peak of 1,565 points in October 2007, it plunged to around 676 points, losing more than half its value. The FTSE 100, which represents the 100 largest companies on the London Stock Exchange, fell from a peak of about 6,700 points in June 2007 to around 3,500 points by March 2009, a nearly 50% drop. The Nikkei 225, Japan's main stock index, dropped from 18,300 points in December 2007 to just one-third of that by March 2009. These sharp declines reflected massive losses in market capitalization for companies worldwide. They also caused fear and instability in global financial markets, eroding investor confidence. At this point, could banks save companies by providing loans? No, because high interest rates and reduced credit availability left banks unable to help even themselves. Businesses couldn't access loans, halting production, and leading to revenue and profit declines. This forced companies to cut costs by laying off workers. In the US, approximately 8 million people lost their jobs, 2.5 million businesses went bankrupt, and over 140 banks shut down. Spain was hit even harder, with youth unemployment reaching 37%. Many countries around the world fell into recession due to the crisis. Unemployment rates soared, industrial and service production plummeted, and both citizens and businesses lost trust in banks and financial institutions. What did the US government do to address this crisis? They quickly stepped in with decisive measures. One major initiative was the TARP, Troubled Asset Relief Program. This program was designed to rescue large financial institutions and stabilize the economy. TARP initially allocated $700 billion to buy or insure risky assets from banks and financial institutions. It also involved directly investing in these institutions by purchasing preferred stocks or issuing special bonds. TARP played a critical role in saving the US economy during this dire period. It helped prevent the collapse of major banks and mitigated the crisis's global financial impact, gradually stabilizing the market. The US government also introduced massive economic stimulus packages like the ARA, American Recovery and Reinvestment Act. These aimed to increase public spending and support industries hit hardest by the crisis. Inspired by the US, other countries, including those in Europe and Japan, launched their own financial rescue packages. Governments purchased risky assets and provided direct funding to financial institutions to keep them operational and maintain banking system stability. They also ramped up investment in infrastructure projects to create jobs and stimulate economic growth. These included building highways, public facilities, and renewable energy projects. During this time, the US Federal Reserve (Fed) cut interest rates to near zero to stimulate the economy. They also purchased government bonds and other assets to maintain low interest rates and improve borrowing capacity for financial institutions and businesses. The Fed injected new cash into the economy, increasing liquidity and lowering borrowing costs for financial institutions. The U.S. also enacted the Dodd-Frank Act, which required banks to maintain high capital levels and sufficient liquidity. The Consumer Financial Protection Bureau was established to protect investors by overseeing services like mortgages, credit cards, and consumer loans. The act also introduced living wills, requiring large banks to prepare plans for risk management and crisis scenarios. Finally, it mandated greater transparency from financial institutions, requiring them to disclose their activities, risks, and detailed financial information. Dodd-Frank significantly impacted the U.S. and global financial systems, enhancing transparency and public trust. The U.S. government's timely intervention prevented the 2008 crisis from escalating further. It supported the economy through its darkest days and laid the groundwork for recovery. However, it took nearly a decade for the financial sector to fully recover from the psychological and economic effects of the housing bubble collapse. So, what are the lessons we can learn from this? First, the old saying still holds true. Banks run on trust, and you lose everything. The 2008 crisis proved that risks at just a few financial institutions can quickly spread and severely impact the entire global financial system. That's why maintaining public trust in the financial system is crucial. Second, risk management must be systematic. The lack of proper risk management by banks in this crisis had massive negative effects on the global economy. This highlights the need for stricter regulations and standards for risk management, including capital and liquidity requirements. These need to be closely monitored by government agencies. Transparency in financial operations is essential to strengthen trust from investors and customers. Because in the end, trust is the key factor in investment. Risk management is a fundamental condition for ensuring the stability and sustainability of not only the global financial system, but also personal finances. Lastly, in an economy that heavily relies on credit, borrowing to spend and invest, we must also recognize the downside of credit. This lesson isn't just for the US, but applies to all countries around the world. To summarize, in today's video, we explored the causes, events, and lessons of the 2008 financial crisis. It all started with subprime loans and the Fed's low interest rates, leading to the housing bubble. When the bubble burst, many banks and financial institutions collapsed due to their investments in risky assets like MBS and CDOs. A lack of transparency and inaccurate credit ratings from rating agencies worsened the situation. When everything spiraled out of control, the U.S. housing market crashed. Major banks collapsed under the pressure of financial products, causing a sharp global economic downturn. Unemployment rose, production fell, and public trust in the financial system plummeted. To stabilize the market and rebuild the economy, the U.S. government and other countries quickly implemented stimulus measures and massive bailout packages. I hope that after today's, you not only gained a deeper understanding of one of the most serious financial crises in world history, but also learned valuable lessons about credit that you can apply in real life. This knowledge can help you make smarter decisions in managing your personal finances. Always remember, as a consumer, spend wisely. As a business person, invest smartly and strategically. As a policymaker, carefully consider key economic factors when making decisions that affect communities. Let's all aim to be important contributors to building a sustainable and thriving economy. That's all for now. Thank you for taking the time to watch this video. It was created based on research from various sources and personal analysis. If there's anything missing or incorrect, feel free to comment below. Don't forget to subscribe to the channel to continue exploring fascinating economic stories in future videos. This is Drake Lees. Goodbye, and see you next time.